Please like, share, and subscribe. Wishing you happiness and good luck every day.
Welcome to The Explainer. Today, we're diving into Thor Young's A Complete Day Trading System. Now, this is all about a huge promise. How to shift from being a gambler at the mercy of the market to, well, a calculated speculator. Let's break down how that's even possible.
And this quote right here from the legend Richard Wyckoff just hits the nail on the head. He says the difference between speculating and gambling isn't what you're doing, it's the intelligent foresight behind it. So, the big question is, what exactly is that?
Right, and there's the rub. In the wild, super-fast world of day trading, where do you find that intelligent foresight? Because the market is just this chaotic storm of noise, and day traders are up against a unique and honestly, a brutal restriction that your typical long-term investor just doesn't have to deal with.
And that restriction? It's time. Pure and simple. As a day trader, you've got hours, maybe minutes, to make a trade work. You don't have the luxury of waiting days or weeks for things to play out. And that means a lot of the old-school, slower systems, they're just not built for this game. They can't keep up.
Okay, so if you're going to find that foresight under immense time pressure, Thor Young argues that what you need isn't just one little trick or strategy. No, you need a complete system, something that hands you a concrete plan of attack before the opening bell even rings.
And according to Young, any system worth its salt has to answer three fundamental questions. First, where do you even look for a trade? Second, when is the right moment to pull the trigger? And third, how do you manage the trade once you're in? If your system doesn't cover all three, well, you're not really speculating, are you? You're just rolling the dice. Now, a full system has to answer all three of those, for sure. But the whole thing is built on that very first question. So for the rest of this breakdown, we're going to laser focus on that crucial starting point. In a sea of literally thousands of stocks, where on earth do you even begin to look?
The system's answer to that where question comes down to a specific tool called Camarilla Pivots. Now, don't let the name scare you. Simply put, these are just key price levels that are calculated using yesterday's trading data. The best way to think of them is like a pre-drawn map that you lay over today's completely blank chart.
So why do these levels even work? Well, the whole theory is based on some pretty simple human psychology. At its core, the market is just one giant auction. And what happens at every auction? People overreact. They get swept up in the excitement or the panic, and they push prices way too far above or way too far below what something is actually worth. These Camarilla Pivots, they're designed to mathematically pinpoint where those predictable overreactions are likely to happen.
And this is where it gets really cool. You can see here how these calculated pivot levels totally transform a confusing, chaotic chart into a clear, actionable map. All of a sudden, you've got these defined zones that tell you where to pay attention, and maybe just as important, where you should probably just stay away.
The system makes this super intuitive with simple color coding. The green levels, those are your potential go zones for buying. The red levels, those are areas to look for selling, or for shorting, betting the price is going to drop. And that gray area smack in the middle, the book calls that the kill zone. It's a choppy, unpredictable mess, and the smartest move you can make there is to just sit on your hands. It saves you from that terrible feeling of forcing a trade when the market's just going sideways.
But here's the thing. This map does way more than just show you a few static lines on a chart. The real power comes from looking at the relationship between these levels from one day to the next. That's how you start to decode the market's mood before you even think about placing a trade.
This whole process is called determining the directional bias. It's basically a way to get a read on whether the overall market sentiment is leaning bullish, bearish, or just neutral. And you do it just by looking at where today's entire map of pivot levels is sitting in relation to yesterday's map.
And this image just illustrates it perfectly. Look at the left side. See how today's whole pivot structure has physically shifted up from where it was yesterday? That's a clear bullish bias. Now look at the right. The entire structure has shifted down. That's your bearish bias. It's a dead simple visual check of the market's underlying pressure.
And this isn't some obscure little pattern just for retail traders. The really crucial takeaway here, according to the source material, is that this exact logic, understanding the relationship between these value areas from day to day, is the same kind of thinking used to build some of the most powerful and influential trading algorithms on Wall Street.
All right, so how does this all come together to give us the final piece of the where puzzle? We've got our map, we've decoded the market's mood, now we need to turn that into a concrete, actionable plan. Okay, so the bias gives you the probability for the day, but it's the opening price that acts as the final confirmation. Think of it like the market's first vote of the day. It tells you right away if it agrees with that bias you identified or if it's about to reject it completely.
So, for example, let's say your homework shows a clear bullish bias. If that stock then opens really strong, punching above that key R4 breakout level, boom, the system gives you a clear, predefined plan to trade that upward momentum. You're not guessing, you're not hoping, you're just executing plan A.
But what if that same stock, the one with the bullish bias, opens weak? What if it fails to break through that key level? Well, the system doesn't just leave you hanging. It gives you a totally different plan, let's call it plan B, for trading that rejection. It's a bullish failure, and the plan is to trade it back down towards the middle of the map, towards that fair value area.
And that right there is the entire point. You're no longer just reacting to chaotic price swings. You've already identified the key decision points before the market even opens, and you have a specific plan for what you're going to do based on how the market behaves at those levels. This level of preparation, well, that's the very definition of intelligent foresight.
So by giving you a clear map of where to look, and then a set of if this then that plans based on the market's own actions, this system really tries to fundamentally change a trader's entire approach. Which brings us back to that original question. If you have a map and a plan for any scenario, are you still just gambling, or are you finally speculating?
All right, let's jump right in. Today, we're going to break down a really fascinating day trading system. It's one that promises to bring a little bit of order to the wild and, let's face it, often chaotic world of the stock market. Think of it as a way to find a clear signal inside all that noise. I mean, you look at any chart on any given day, and it's so easy to think so, right? Prices are flying up, they're crashing down. It can feel completely random. But what if it isn't? What if there are these underlying patterns that are driven not by some random chance, but by something much, much more predictable? I'm talking about human psychology. And that, right there, is the core idea we're going to dig into. See, most trading tools, they try to give you an entry signal, a win. The Camarilla Pivot system, though, it does something totally different. It gives you a map. It literally highlights specific locations on the chart where the market psychology is most likely to have a reaction. So, to really get how this map works, we're going to walk through 4 key ideas. First up, we'll talk about the search for value. Then, we'll get into how and why markets overreact. After that, we'll see how these Camarilla pivots actually map out the psychology. And finally, we'll get practical and look at exactly how you can trade these levels. Okay, let's start with the absolute foundation of this whole thing, value. To make any sense of the market's movements, we first have to have a solid grasp on what value really means in this game. Now, this is so important. Value isn't some fixed number you can find on a spreadsheet. In the world of day trading, value is simply the price where a buyer and a seller agree to make a deal. That's it. It's a perception. And because our perceptions are always changing, value is constantly in motion, second by second. So really, the entire dance of the market, all that up and down, it all boils down to this one simple question. Is this stock a bargain right now, or is it getting a little too pricey? And the collective answer from millions of traders is exactly what moves the price. Now let's build on that. If value is just a collective perception, then we really need to understand the psychology behind those perceptions. And this leads us to a very, very human and very predictable tendency. This quote from the source material is pretty much the key to the entire system. And it's so true, right? Just think about your own life. We get way too excited about good news, and we get way too down about bad news. It's how we're wired. And because the market is nothing more than a giant collection of human beings making decisions, that same exact psychology gets baked right into a stock's chart. A stock develops a personality. It doesn't just move randomly, it overreacts. It stretches too far up, it stretches too far down, and then it tends to snap back toward an average. And this creates a rhythm, a predictable rhythm. And here's what that looks like in the real world. Check out this chart. The price isn't just going in a straight line. It pushes up, gets a little stretched, a little too far from its average value. That's that yellow line. And then it comes back. It dips below, gets too far away again, and snaps back. This ebb and flow, that is the market's predictable overreaction in action. So this is the core theory we can actually build a trading system around. The idea is that we can expect the price to keep returning to its accepted value, or its mean, over and over again. Now, the moments it fails to return, Well, those are just as important, because that's when a whole new trend might be starting. Okay, so we have this great theory based on psychology. But how do we turn that into something we can actually see and use on a chart? Well, that brings us to the tool that was literally designed for this job. And this isn't some newfangled idea that just popped up. The math behind these Camarilla pivots was actually discovered way back in 1990. It was apparently so effective that it was kept under wraps for years, sold to just a few traders. But eventually, a good idea gets out, and now it's been adapted and built right into the trading platforms that we all use today. So here's the million-dollar question. How do you take this abstract idea of market overreaction and turn it into actual, concrete lines on a chart? How do you map these potential turning points before the market even opens? The answer is in these surprisingly simple formulas. Now, don't worry about the math. Your software does all the heavy lifting. What's really important here is the concept. The system takes the previous day's high, low, and closing price, and it uses that data to project a series of key support and resistance levels for today. It's basically using yesterday's story to draw today's map. And this is where it all clicks into place. You plug those formulas into your charting software, and bam, you get a visual map just like this one. And honestly, the color coding is everything. It transforms those numbers into an intuitive, actionable guide for your trading day. Green, red, and gray. Each color has a very specific job. Which brings us to our final, and let's be real, most important section. We've got the map. Now, how do we actually use it to navigate the market? This strategy here is actually beautiful in its simplicity. The green levels, those are your primary zones to hunt for long or buy setups. The red levels are where you start looking for reasons to go short. And then you have those gray levels smack in the middle. That is the kill zone. It's an area of chop and indecision where, frankly, the best trade is usually no trade at all. Let's look at this in action. It's pretty cool. On the left, you see the SPY opens near the green S3 level, finds support, and then starts this nice journey all the way up to the red R3 level. That's a classic bullish move. On the right, Meta does the complete opposite. It hits its head on the red R3 level and falls all the way down to the green S3. These are just perfect examples of price traveling between these key zones. Okay, I'm going to repeat this quote, because if you remember one thing from all of this, let it be this. These lines are not automatic buy or sell signals. They are locations. They are zones on the map where you should start paying close attention and look for your favorite trade setup. It's a map that shows you where the treasure might be, not the treasure itself. And maybe the biggest benefit of trading this way is actually psychological. It forces discipline. Instead of chasing price all over the place inside that messy, gray kill zone, you are forced to sit back, be patient, and wait for the price to come to you, to come to one of your predefined red or green areas of interest. So let's do a quick recap. Value is a perception. It's always changing. Markets overreact because, people overreact. Camarilla Pivots use simple math from yesterday to map out today's key psychological levels. Green is where we look for buys, red is for shorts, and we absolutely stay out of that gray zone. And most importantly, we remember, this is a system that tells us where to look, not a magic button that tells us when to trade. And so I'll leave you with this final thought. Is any system out there really a map to guarantee profits? Or is the true value of a system like this in how it structures our thinking, enforces that discipline we all need, and gives us a clear, logical framework to help us patiently, calmly navigate the wonderful chaos of the market? Something to think about. All right, let's talk about getting an edge. Today, we are diving deep into a really powerful tool for day traders, pivot relationships. This is all about understanding the market's bias before you even think about placing a trade. You know the feeling, right? You'll wake up, grab your coffee, and ask that one big question. Which way is this market going today? It feels like you're trying to read its mind. But what if I told you there's a way to get a solid, data-driven clue before the opening bell even rings? Sounds good, right? So here's what we're going to cover. First, we'll decode what these pivot relationships are all about. Then we'll look at the 3 main market biases they reveal. After that, we'll get into the fun stuff, specific trade setups for both bullish and bearish days. And we'll finish up with a super important piece of the puzzle, inside versus outside days. All right, let's jump right in. Section 1, decoding pivot relationships. Look, this is all about figuring out the market's most likely direction before you even think about risking your capital. Honestly, it's the most important first step you can take. At the heart of all this is something called the central pivot range, or CPR for short.
Now, this is basically a zone that's calculated from the prior day's price action. Think of it as a high-value area. But here's the secret sauce. Today's CPR by itself doesn't tell you much. The real magic, the real edge, comes from seeing where today's CPR is in relation to yesterday's. That comparison, that's everything.
And that relationship is what reveals one of 3 core market biases. See, the market is literally telling you a story every single day based on where it's establishing value. The real question is, are you listening to it?
Okay, first up, a bullish bias. This one's super easy to spot. If today's central pivot range is completely higher than yesterday's range, that's your signal. It's a big clue that the market is accepting higher prices, pointing to a potential uptrend for the day.
And you guessed it, the exact opposite is true for a bearish bias. When today's CPR forms below yesterday's, the market is signaling weakness. It's like the center of gravity for value has shifted down, suggesting a potential downtrend.
And the third one? That's a neutral bias. This happens when today's CPR is literally inside of yesterday's. It's basically the market saying, I'm not sure yet. It signals consolidation. But hey, don't you dare think neutral means boring. These tight, coiling patterns, they often lead to absolutely explosive moves.
Okay, so now we know how to identify the bias. That's great, but how do we trade it? That's what this next section is all about, turning that bias into actionable trade ideas. Let's dig into some specific bullish trade scenarios.
First up, the classic, the bullish breakout. This is that picture-perfect trend day. The market has a bullish bias, it opens strong, and it just goes. The momentum from yesterday just spills over, blasting through key resistance. So, what are we looking for? Here's the checklist. Number 1, yesterday had to be a strong day, closing above that R4 resistance level. Number 2, today we need to open above that same R4 level. And number 3, and this is crucial, you want your long entry to be as close to that R4 level as possible. We don't want to be chasing the price way up high.
But, breakouts don't always work. And that brings us to scenario number 2, the bullish failure. This is where the price pokes its head above R4, it tries to break out, but it just can't hold. It gets smacked back down into the range. And guess what? That failure is actually a fantastic shorting opportunity.
All right, next up is the bullish bounce. In this setup, the market opens and pulls back a bit, right, into a key value area. But instead of breaking down, it finds its footing, it finds support, and boom, it bounces and continues the uptrend. This is your classic buy the dip play on a day with a bullish bias.
And our fourth scenario on a bullish day is a tricky one. It's the bullish trap. Now, this starts out looking just like a bullish bounce. You get the pullback, you get the bounce, but here's the twist. The bounce runs out of steam at a key resistance level, maybe R3, and it fails. All the traders who just bought that dip are now trapped, and the price heads back down.
Okay, so we've covered the sunny days. Now let's flip the script and look at the other side of the coin. It's time to dive into bearish trade scenarios and figure out how to profit when the market is heading south. And our first one here is the perfect mirror image of what we saw before, the bearish breakout. The market has a bearish bias, it opens weak below a major support level like S4, and the sellers are just relentless. The price just keeps sliding lower all day. And the rules for this are just as clear. Checklist time. First, the previous day had to be weak, closing below that S4 support. Second, today we have to open below S4. And third, just like before, you want to get your short entry as close to that S4 line as you can for the best possible risk to reward. Next, we have the bearish cover. So what's this? It's when a big sell-off just runs out of gas. The price tries to push below S4, but it fails. There are no more sellers. And then it starts to reverse. This can be a great long opportunity because all the short sellers now have to cover. They have to buy back their shares, and that buying just fuels the rally higher. All right, scenario 7 is the bearish sell-off. This is when the market is weak, but it tries to muster a little relief rally, a little bounce, but it pushes up into a value area and just gets rejected. It hits a wall. That failure to rally, that's your big signal that the sellers are still in complete control and the next leg down is probably coming. And last but not least, for the bearish side, we have the bearish squeeze. Oof, this is the ultimate pain trade for anyone who's short. The market looks like it's about to roll over and die, but then, bam, it finds a bottom and just rips higher. This squeezes all the short sellers, forcing them to buy back at much higher prices, which just throws gasoline on the fire.
Okay, we've got our biases, we've got our trade scenarios, but there's one more layer to this, a final filter that really helps you refine your strategy for the day. And that is understanding the difference between an inside day and an outside day.
And it's all about the width of the CPR. It's actually pretty simple. On the left, you can see an outside day has a really narrow CPR. On the right, an inside day has a nice wide CPR. Just looking at the width of this range gives us a massive clue about what kind of day we should expect. Let's break that down. Look at the outside day, the one with the narrow CPR. Think of that narrow range as a coiled spring. It's primed for a breakout. So on these days, you're hunting for moves that push beyond R4 or S4. Now, flip that. On an inside day with that wide CPR, the market is telling you it'll probably be more range-bound, so the strategy changes completely. Here, you're looking to play reversals, fading the edges of the range around R3 and S3. So you see how this all fits together? By understanding the day-over-day pivot relationship, you get your bias, and by checking the width of the CPR, you know whether to play for a breakout or a range. You're no longer just guessing, you're strategizing. You literally have a roadmap for the trading day. So the only question is, where are you going to go with it?
All right, welcome. Today, we're cracking open a professional day trader's playbook. We're going to break down exactly how they use these specific pivot point strategies to take all that market chaos and turn it into a structured, repeatable game plan. A strategy that works no matter what the market decides to throw at them on any given day.
You know, every single trader wakes up and asks the same exact question, right? Is today going to be a bull run, a bear market, or just a choppy, sideways mess? Honestly, that unpredictability is probably the single biggest challenge we all face in day trading.
But what if you didn't have to guess? What if you had a playbook with a specific, pre-planned strategy for each one of those conditions? Well, that is exactly what we're building today. A system designed to take the guesswork right out of your trading. So, the system we're diving into is called the Pivot Strategy Playbook. It's really just a method for identifying what the market is likely to do and then executing a specific play that's designed for that exact scenario. No more just using the same old pattern and hoping it works today. Now, the foundation for this whole system is pivot points. The best way to think of them is like a pre-calculated map for the trading day. They show you all the key support and resistance levels based on what happened the day before. These are the zones where we're going to look to make our moves. First up, we have what's called an inside day. You spot this when you see a really wide central pivot range. So you might be asking, why does a wide range mean a choppy day? Well, think about it. It means that yesterday, buyers and sellers were really battling it out, and nobody won. They basically agreed on this big area of value. And that kind of indecision, it usually spills over into the next day. So our game plan here isn't to hope for some massive breakout. Nope. The strategy is to trade within that established range.
Okay, so if we're expecting a choppy, sideways kind of day, what are the actual plays? Let's get into the specific, actionable strategies that are designed for exactly this kind of market.
So here you can see the two main plays for an inside day. Over on the left, you've got a bearish traverse, and on the right, a bullish squeeze. The key thing to notice is that they are perfect mirror images of each other. This gives you a plan whether you think that chop is going to eventually lean bullish or bearish.
For the bearish version, the R3 to S3 traverse, the setup has to be just right. You need a bearish relationship to the prior day, that wide pivot range we talked about, and open below the R3 resistance level, and a bearish level 2 or order book. That just means you can see more sellers lining up than buyers. If all those boxes are checked, the play is to short the stock right at that resistance, and you're targeting a move down to the S3 support.
And you guessed it, the bullish play is the exact opposite. For the S3 to R3 traverse, you're looking for a bullish setup, that same wide range, but this time an open above the S3 support level, and a bullish order book. More buyers are stepping in than sellers. Here, the plan is to buy the stock as it tests that support, looking for a bounce back up towards R3 resistance.
Now, this is absolutely crucial. Not all the space between those pivots is good for trading. The system actually defines something called a kill zone. This is an area where the price is just going to be super choppy and totally random. A core rule for a professional is to never take a trade inside a kill zone. It's all about playing the probabilities, and the odds are terrible in there. So, if we avoid the chop, where do we find the big trends?
Well, that brings us to the complete opposite scenario, the outside day. You can spot this when you see a narrow central pivot range. So why does a narrow range signal a big move?
because it shows the market was coiled up super tight the day before, just building up energy. A break from that kind of compression can lead to a really powerful trending move. Here, the whole strategy shifts to playing for that breakout and just riding the trend.
For these days, the ones that could be explosive and directional, the playbook calls for a totally different set of strategies. These are all about recognizing when the market has real conviction and just jumping on board with the move instead of trying to fight it.
And this slide lays out the two main breakout plays beautifully. On the left, we've got the R4 strong buy for a bullish trend, and on the right, the S4 strong sell for a bearish trend. Think of these as momentum plays, designed to get you into a stock that is showing you clear, undeniable signs of a strong directional move.
The R4 breakout has a really clear checklist. You need a bullish or neutral bias, that narrow pivot range, and, this is key, an open with strong volume above the R4 level. That shows the market is immediately accepting higher prices. A little pullback to test that R4 level becomes your entry point for a continuation move higher.
And for the S4 breakout, the strong sell, the checklist is pretty much the mirror image, but for the bears. You're looking for a bearish or neutral bias, the narrow pivot range, and an open under the S4 support level. This is a big signal that sellers are rejecting the previous day's value. The play is to get short and ride that downward momentum.
Okay, so we've covered the basic plays for different market types, but now we're going to get into something a little more advanced, an expert-level insight. This is really the kind of nuance that can separate a developing trader from a pro. You ready for this?
This is a big one, and the source material really emphasizes that this is a detail you probably won't find in most trading books. It's a subtle but incredibly powerful adjustment to how we use our main tool, the pivot points themselves. It all boils down to this question. When you calculate your daily pivot points, should you include the pre-market data? I mean, a huge overnight gap could make yesterday's regular hours data kind of useless, right? But including pre-market on a quiet night might just skew your levels. So, what's the right answer?
The pro move is to stop trying to choose. Instead of guessing which calculation is going to be more accurate today, you use both of them. That's the secret. By overlaying the pivots calculated with pre-market data and without it, you create something way more powerful, a high-confidence zone.
And here's the proof in the pudding on a real trade in Netflix. Just look at that chart. The two different R4 calculations create a tight resistance zone, not just a single line. This gives you a much higher confidence area to take a short trade. And maybe just as important, if the price cleanly breaks above both of those levels, well, that's a crystal clear signal that your trade idea is wrong and you can get out and cut your losses quickly.
Okay, after all that detail, let's zoom out for a second and look at the big picture. These strategies, as powerful as they are still only one piece of a much larger puzzle. It's super important to understand that.
I really want to end with this powerful quote from the source material. This entire playbook, it tells you where to find high probability trades, but to have a truly complete system, you also need to know when to execute and how to manage that trade once you're in it. So is this playbook the secret to success? Well, it's an absolutely essential first step, but it's not the whole story. The real question for you is, what's the next piece of your puzzle that you need to solve?
All right, welcome. Today, we're going to peel back the layers of the stock market. And I mean really get in there. We're going to uncover the human drama that's happening right behind those price charts. And trust me, it's going to completely change how you see every single tick up and down.
So let's just dive right in with this idea, because it's a powerful one. Stop seeing numbers on a screen. Seriously, start seeing people. Why? Because behind every single transaction, there are competitors, locked in what is truly an epic financial battle. And that right there is the heart of market auction theory. You see, the market isn't some cold calculating machine. No way. It's organic, it's emotional, and it's all driven by good old-fashioned human psychology. And think about it, even an order placed by some fancy algorithm, well, it's got human bias programmed right into its code. Okay, so if the market really is a battle, then who are the soldiers? Well, it turns out they pretty much fall into four main groups, and each one has totally different motivations and strategies. Understanding these four key players is really the key to decoding the whole battle. We've got the aggressive attackers and the staunch defenders. You've got the giant whales that actually move the market, and then you've got the schools of smaller fish just reacting to them. Knowing who has the upper hand, that's everything. So this brings us to this really fundamental conflict. On one side, you have your initiative players.
These are the ones chasing momentum. They see a price breaking out and they jump on board, hoping that trend is going to carry them higher. But then, on the other side, you've got the responsive players. They're betting on that exact trend to fail and for the price to snap right back to where they think it belongs.
And here is a classic initiative move in action. See that circled area and that spike in volume right below it? That is the footprint of a stampede. It's initiative buyers rushing in, trying to force the price past a key level.
But what happens when that breakout fails? Whoa, the result is powerful. That initial push higher gets smacked down and the responsive sellers just overwhelm the market. This is where you get that old saying, stairs up, elevator down. The reversal can be so swift and brutal because all those hopeful initiative buyers are suddenly forced to sell.
Now, beyond how these players trade, we have to think about the scale of who's trading. This is the difference between the strong hands, we're talking large institutions with deep pockets who actually create the major trends, and the weak hands, the smaller traders who, let's be honest, are often just reacting to the waves that the big players make.
Okay, so we've met our players. Now let's take a look at the arena where this whole thing plays out, the market auction cycle. This is the predictable rhythm of the market's battle.
I want you to imagine the market moving like the hands of a clock, constantly rotating through these 4 phases. It really only has one job, to find a price where buyers and sellers agree to do business. That's it. It finds that price, moves away from it, and then it begins the search all over again. It never, ever stops.
So the cycle often kicks off with what we call imbalance. This is pure price discovery, and you see it most often right at the market open. It's chaotic, it's volatile, you see prices just whipping all over the place as the market frantically searches for a level that everyone can agree on.
In all that chaos, it's a search for this, value. This is the #1 goal of the whole auction, to find that sweet spot, that price, where the most business is getting done because both sides feel like it's a fair deal.
Now, once that value is established, the market can finally take a breath. It enters a state of balance, and this is a period of calm, a consolidation where supply and demand are pretty much equal, and since everyone's content for the moment, the volume is characteristically low. But of course, that calm, it never lasts. Inevitably, an excess of either buying or selling starts to build up, and suddenly that fair price starts to feel pretty unfair. This tension breaks the balance and boom, it throws the market right back into the imbalance phase, starting the whole cycle all over again. Okay, so with this whole theory in mind, how do we actually apply it, right? How can we actually see where the strong hands are placing their bets on a live chart? Well, we can start to figure out what value is with a really simple idea. It's the price level where the most business has gotten done. That's it. Think of it as the market's center of gravity, the price where the absolute highest volume of shares has changed hands over a set period of time. And hey, the good news is you don't have to guess where this high volume area is. Nope, most trading platforms have a super powerful indicator called the Volume Point of Control, or VPOC for short, that shows you this market center of gravity right there on your chart. So on this chart, see that horizontal yellow line? That's the VPOC. It's marking the single price with the highest volume of trades for this whole period. This high-value area literally acts like a magnet, constantly pulling the price back toward it, until one side of the battle, the buyers or the sellers, finally wins decisively. Okay, let's pull all of this together. Let's create a simple but really powerful framework for seeing the market in a completely new way. So here's how you put it all together. First, you've got to stop seeing random noise and start seeing a constant auction for value. Second, identify the players in the current battle. Ask yourself, are the aggressors or the defenders in control? And then finally, follow the strong hands. Use a tool like VPOC to see exactly where they're doing the most business, and I promise you, you'll see the battlefield in a whole new light. Look, at the end of the day, this isn't just another trading strategy. It's a new lens, a new way to see the living, breathing story behind the price. So the next time you look at a chart, you got to ask yourself, are you just seeing lines or are you seeing the battle?
All right, today we're going to pull back the curtain on the market. We're not just looking at charts. We're trying to get into the engine room to understand what's really going on. We're going to talk about how you can read the hidden story that volume and price are telling you, a story that shows you what's really driving every single move.
So let me ask you something.
Have you ever been there? You spot the perfect setup. I mean, it's right out of a textbook. You've seen it 100 times. So you jump in, feeling pretty good about it, and then, boom, the market just turns on a dime and stops you out. And you're just left there scratching your head thinking, why does that keep happening?
Well, the answer, more often than not, is all about focus. See, when you zoom in on that one little pattern, you're trading the micro. You're seeing the trees, but you're completely missing the forest, that macro environment where these much bigger forces are at play. Forces that can just completely crush an otherwise perfect setup.
So, what are these big, powerful forces? Well, to really get the macro picture, we have to go behind the scenes and meet the folks who are actually driving the bus here. And those are the market makers. Now, these are not your average traders working from home. Market makers are the giants, the huge institutions whose entire job is to literally create the market that we all trade in. They provide the liquidity, they handle the massive order flow, and you better believe they see everything that's going on.
Yeah, just look at this. On floors just like the NYSE, these guys are right at the heart of the action. They're moving a truly mind-boggling number of shares every single day. The scale they operate on is just, it's hard to even wrap your head around.
Okay, and this is absolutely crucial to understand. How do they make their money? It is not about buying a stock and hoping it goes up. Their profit comes from the constant churn of transactions. They get commissions, they make money on the spread, that tiny difference between the buy and sell price. Their goal isn't to be right about direction, it's to keep the orders flowing. This revolving door analogy is just perfect. They are constantly in motion, buying from anyone who wants to sell and selling to anyone who wants to buy, and just clipping a small profit on every single turn. They don't take on much risk because they never hold a position for very long. They just facilitate the market's traffic.
And here are two amazing ways to think about what they do. On one hand, they're like your power company. You don't try to compete with the power company, right? You just use their service. For traders, that service is order flow. But on the other hand, they're also like an Amazon warehouse. Before they can sell anything, they have to fill that warehouse up by accumulating a ton of shares.
Okay, so if these guys are so powerful, how in the world can we possibly trade alongside them? Well, it turns out they have a tell, a kind of hidden language that gives away what they're doing, if you know how to read it. And that language is volume.
You see, these big players can be pretty sneaky. They can break up their orders, route them in complex ways, but the one thing they can't hide is the volume. Every huge transaction, every time they're quietly buying up stock or selling it off, it leaves a footprint. At the end of the day, volume tells the truth.
Think about it like you're at an auction. How do you know which items are getting all the attention? You just look for the biggest crowd of people, right? Well, volume is that crowd in the market. A big spike in volume is like a giant flashing sign telling you, hey, the big players are over here. This is where the action is.
So now for the really cool part. How can we actually use volume to figure out what they're up to? The trick is to look for moments when things don't quite add up, when the relationship between the price and the volume gets weird. We call these anomalies.
You could almost think of it like a law of physics for the market. Normally, a certain amount of effort, which is the volume, should produce a proportional result, which is the price moving. An anomaly is when that law breaks. When you see a huge amount of effort for very little price movement, or a big price move on almost no effort. That mismatch, right there, that's your clue.
And this is where it all starts to click. I mean, we've all seen candlestick patterns like a hammer or a doji a million times. On their own, they give you a hint. But when you add that third dimension of volume, their meaning becomes crystal clear. A doji candle on low volume? That's just a bit of indecision. But a doji on massive, massive volume? Whoa! That's a full-blown war between buyers and sellers.
So here's our first big anomaly. Effort without movement. You see this huge spike in volume, right? An incredible amount of buying is pouring in, but the price barely moves. It just closes in this tight little candle. So what does that tell you? It means there is an equally massive wall of selling that is absorbing all of that buying pressure. The price has hit a brick wall, and a reversal is probably right around the corner.
And then we have the exact opposite, movement without effort. The price is still kind of drifting up, but look at the volume. It's just drying up, getting smaller and smaller. This tells you there's no real power, no conviction behind this move. The buyers are getting tired, and that trend is super fragile, just waiting for someone to push it over.
So once you start to spot these anomalies, you begin to realize something amazing. The market isn't just a bunch of random noise. It actually moves in predictable phases, all part of a very deliberate campaign that's being run by those same market makers we've been talking about.
This chart here really shows the whole cycle. See? It's not just a chaotic mess of zigzags. It's a calculated process with very distinct stages, all the way from building up a position at the bottom to selling it off at the top. And if you can understand these stages, you can finally put yourself on the right side of the market.
Now, this campaign usually follows 4 main steps. It kicks off with accumulation, then there's a testing and transition phase, then it moves into distribution, and it wraps up with a selling climax. For now, let's just focus on the 2 big ones, accumulation and distribution.
So phase 1 is accumulation. This is where the market makers are quietly filling their warehouse, buying up all the shares they can at low prices. They might even push the price down on purpose to scare people, to shake out the weak sellers so they can scoop up even more inventory for cheap.
Then, after the stock has had its big run, we get to the distribution phase. Now their warehouses are full to the brim, and it's time to sell. They start to empty the shelves, offloading all those shares to the retail traders who are excitedly jumping in at the top. This is where you'll see those effort without result anomalies pop up all the time.
So here's the bottom line. By learning to read the volume, by spotting these anomalies that tell you when they're done buying and when they're starting to sell, you can stop getting caught on the wrong side of the trade. You can actually see their campaign unfolding in real time and finally start trading with the smart money instead of against them.
So now you have the map. You can see the footprints they leave behind on the charts every single day. The question isn't what is the market doing anymore. The question is, now that you can see where the smart money is going, where are you going to follow them?
Let's talk about the stock market. But forget everything you think you know about random charts and unpredictable swings. What if I told you it's not random at all? That it's actually a game with its own hidden rules and some very powerful players. Today, we're going to learn how to play it. You know, if you're a trader, you've definitely felt this. It's that creepy feeling that the market is personally out to get you, that some invisible force is just hunting your position. Well, what if you're not just being paranoid? I mean, seriously, think about it. You set your stop loss, you think it's in a safe spot, and then you watch in horror as the price dives down, tags your stop perfectly to the penny, and then immediately screams back in the direction you predicted. It feels impossible, it feels personal. And that's the real question, isn't it? This quote here hits the nail on the head. If the odds of that happening are so ridiculously low, why does it feel like it happens all the time? Well, because there's something else going on under the surface. And here's the secret. You're not being hunted by a person. You're being found by a system. You see, the big market maker algorithms, they have a bird's eye view of everything. They can see exactly where all the stop-loss orders are piling up. It's not a personal vendetta. It's just a systematic hunt for liquidity. So to survive this hunt, you have to understand the ecosystem. The market isn't some fair and level playing field. Nope, it's more like a giant ocean. And in this ocean, you're either one of 2 things. On one side, we've got the weak hands. We're going to call them plankton. That's most of us, smaller traders. And on the other side, you've got the strong hands, the whales. These are the huge institutions that can literally move the market. And the biggest difference isn't just their bank account, it's their tolerance for risk. Plankton get scared and sell at the first sign of trouble. Whales? Well, whales create the trouble. This quote really just lays it all out there, doesn't it? As a smaller retail trader, you don't move the price. You are basically just trying to survive in an ocean that's absolutely full of giant whales. So if we're the plankton, how do the whales feed? What are they looking for? It all comes down to one critical concept, the stop zone. So what is a stop zone? It's simply a predictable price level where a ton of us, the plankton, all put our stop loss orders. We all learn the same basic strategies, right? So we tend to put our stops in the same obvious places. For us, it's a safety net. For a whale, it's a giant, flashing, all-you-can-eat buffet sign. It's where they go to find enough orders to fill their massive positions. Okay, let's actually see what this looks like on a chart. You see that sudden, violent drop? That is not a random market fluctuation. That's a deliberate push, an engineered move by algorithms to ram the price right into that stop zone. It's called a shakeout, and its only purpose is to trigger a flood of selling from all the weak hands and clear them out of the way. And here's part 2 of the play, the flush. Right after everyone has been scared out of their positions, the whales step in and quietly buy up everything at a discount.
And then what happens? Boom, a massive rally in the direction everyone thought it would go in the first place. The competition is gone, and they have a clear path to push the market wherever they want. Now, I know this sounds pretty bad, like the game is rigged, but it's not hopeless. The key to survival is to stop trying to fight the whales. You can't win. Instead, you have to learn to read their behavior, to speak their language. The market leaves clues, and if you can spot the patterns, you can see these moves coming. The first pattern you need to know is called consolidation. Think of this as the market just taking a little breather. The price action gets quiet, it stalls out, usually on pretty low volume. It's just catching its breath before it decides to continue its trend. And here's what that looks like. See how the price just kind of goes sideways and the range gets tighter? That's your consolidation. It's a sign to just be patient. The market's resting, preparing for its next likely move. Now, it is absolutely crucial that you don't confuse consolidation with its much more intense cousin, compression. This is totally different. This is when the price slams into heavy resistance and the volume is high. This isn't a rest stop. This is an all-out war between the big buyers and the big sellers. It's like coiling a spring tighter and tighter. And you can see that battle right here. The price range is tightening up again, but you can feel the tension. All that volume, all that pressure building up. It's a huge tell that a really big, really volatile move is right around the corner. So just to make it crystal clear, consolidation, low volume, a quiet pause, like a rest stop on the highway. Compression, high volume, a major battle, the main event getting ready to kick off. Knowing the difference is everything. And that coiled spring eventually has to snap. And when it does, you get the payoff. You get expansion. This is that huge, explosive move that happens when the market finally breaks free from all that tension. And here it is. This is what it's all about. After all that pressure builds up in compression, the price just explodes in one direction. That right there is the powerful wake of the whale. And that's the wave we want to learn how to surf. Okay, so we get it now. We know who the players are, and we know how to read the patterns they leave behind. So how do we put all of this together into a real strategy that you can actually use? Here's your 4-step survival plan. First, you have to be honest with yourself and recognize that you are acting like plankton. Second, get good at spotting those obvious feeding grounds, the stop zones. Third, and this is the hardest part, you have to sit on your hands and wait. You let the whales do their hunt. Let them shake everybody else out. And then finally, step 4. After the flush is over and the dust settles, you enter your trade and ride their powerful wake. You see, this changes everything. It's a complete shift in mindset. You're no longer trying to predict where the market is going. You're reacting to what the big money is actually doing. The goal is not to be a hero and fight a whale. The goal is to be a survivor who profits from the chaos they create. So that's the hidden game. The market isn't just numbers. It's a living, breathing ecosystem with predators and prey. And now that you know the rules, the choice is really up to you. Are you going to keep being the food, or are you going to learn how to follow the whales? You know, in trading, we're all pretty obsessed with one thing, right? Finding that perfect where to buy or sell. But what if I told you the real edge, the thing that separates the pros from everyone else, isn't about where at all? It's about when. So today, we're going to revive a lost art that answers that exact question, tape reading. Okay, let me ask you something. And be honest. Does this sound familiar? You've done all your homework, you found the perfect price level, a setup that looks like it's straight out of a textbook, but your timing is just a little bit off. Just enough to turn what should have been a great trade into a super frustrating loss. Come on, we've all been there, right? And that feeling, that's probably one of the most common frustrations in all of trading. It's the classic sign that you know you're where, you've got that key level, that pattern down pat, but you're missing a clear real-time signal for when to actually pull the trigger. So this is what we're talking about, the trader's timing problem. Because look, in this game, your idea can be absolutely perfect, but if your execution is off, it's all for nothing. The solution isn't some new, fancy predictive indicator. It's a tool that lets you see exactly what the biggest players in the market are doing, right now, in real time. Yeah, think about it this way. All those indicators we use, moving averages, chart patterns, you name it, they're great. They give you a map, a where to look for a trade. But here's the catch. They're all based on what already happened. They can't tell you about the intense battle that's going on at that price level right now. For that, you got to see the live order flow. Okay, to really get a handle on this, let's use an analogy that I think just perfectly captures what we're trying to do. Let's talk about surfing. You know, a good surfer doesn't just jump on any little wave that comes by. That's a waste of energy. A real surfer waits, they're patient, until they spot a sufficiently large wave with some real power behind it. And trading? It's exactly the same. It's not about taking every little ripple. It's about having the patience and skill to wait for that one wave with real momentum. Because if you jump in too early or too late, you just get wiped out. You miss the ride completely. So, what's our wave in the market? It's the big money. We're talking large institutions, hedge funds, the big players. When they make a move, believe me, the price moves with them. Without their participation, the price is just going to chop around and go nowhere. So your job, as a trader, is to learn how to spot the wave that they are creating.
Okay, so how in the world do you see that big institutional wave forming before it actually breaks? Well, you learn to read the modern version of a tool that absolute legends, guys like Jesse Livermore, relied on for over 100 years. We're talking about the ticker tape. You know, back in the early 1900s, this was a whole different ballgame. You had to be right there, physically close to the exchange. You'd have guys reading this paper tape as it spit out of a machine, and then they'd have runners, actual people running to get the orders down to the trading floor. It was all about speed and being able to interpret that flow of information the second it came in.
And this is what they were looking at, just a simple, raw feed of data. Ticker symbol, number of shares, and the price. That's it. But from that raw data, the smart ones could spot it. They could see unusual volume, aggressive price action, all the little tells that signaled a big institution was stepping in and making a move. All right, this table really breaks it all down perfectly. You've got your predictive indicators, right? They tell you where to maybe look for a trade. Then you have lagging indicators, and all they do is tell you where the price has been. But then you have the real-time indicators, level 2, time and sales, the modern tape. And that, my friends, is what tells you when to trade. Okay, so let's get into the nuts and bolts. How do we actually read this thing? The modern tape really has two main parts. You've got the time and sales window, and you've got the level 2 order book. And when you put them together, they give you this complete live action picture of what's happening. All right, first up, time and sales. The absolute best way to think about this is like the market's receipt printer, and it's one that can't be changed or faked. Every single trade that happens gets printed right here, live. It's just pure, unfiltered data. There is literally nowhere for the big players to hide what they're doing. And the color of each one of these transactions, it tells a story all by itself. It's a story about aggression. When you see green, that means buyers are hungry. They're hitting the ask, maybe even paying above the ask. That shows you real conviction. On the flip side, when you see red and pink, that's sellers hitting the bid, maybe even dumping their shares for less. That's weakness. Sometimes it's straight up panic. But it's not just about the color, you know? It's about the speed, the rhythm of the tape. Is it coming in these short, powerful bursts? Or is it a constant, steady flow? Or has it just gone completely dead? Let me give you a huge pro tip here. If you see that tape speeding up like crazy, tons of transactions flying by, but the price isn't going anywhere, that's a massive clue. It means a huge battle is happening right there, and a big move is probably right around the corner. Okay, so that's piece number 1. Now for the second piece of this puzzle, the level 2 order book. If time and sales is your rear view mirror, showing you exactly what just happened, then level 2 is your front windshield. It's showing you the intentions of all the buyers and sellers lined up right now. It's your live window into the immediate supply and demand. And honestly, the car analogy is perfect. Think about it. You would never, ever change lanes on the freeway without checking your mirrors and your blind spot first, right? That's just crazy. Well, it's the exact same thing in trading. You should never jump into a trade without first checking the tape, both your level 2 and your time and sales, to see what's really happening around you. And as you start watching the level 2, you'll begin to notice something really cool. You'll see these large orders start to pile up at certain price levels. In the biz, we call them stacks. And these huge pockets of buy or sell orders, they act like magnets. They literally pull the price toward them. And in doing so, they reveal these critical, hidden areas of supply and demand that you just cannot see on a normal chart. And this right here, this diagram just brilliantly shows you the whole market auction process in one picture.
Right in the middle, you've got the market makers, the ones providing all the liquidity, and they're just constantly reacting to the confidence and the panic of the buyers, the bulls, and the sellers, the bears. And the best part is, you can see all of their collective intentions playing out, live, right on the tape. Okay, so let's put it all together. How does learning this skill actually give you a real, powerful edge over pretty much everyone else out there? Here it is. This is the whole ballgame. A chartist, they're looking at the past, trying to predict the future. But a tape reader, they're interpreting what is happening right now, in the present. They're not guessing. They are watching the actual real-time order flow and seeing where the money is trying to push the price. Man, I absolutely love this quote because it just nails it. Your chart, with all its patterns and indicators, that's just the wake behind a ship. It can only tell you where the ship has been. But the tape, the time and sails, and the level 2, that is the ship itself. It shows you its real direction, its speed, and its intention right now. So ultimately, learning to read the tape is about making a huge shift in your focus. It's about looking away from the lagging effects you see on a chart and looking directly at the real-time cause that you can only see in the order flow. It's about shifting from just watching the waves to watching the actual ship. So I guess the only question left is, what are you going to pay attention to? You know that feeling, right? That pre-market scramble, it's just this flood of news, charts everywhere, and this intense pressure to find the perfect trade before the opening bell even rings. It can feel like total chaos. But what if you could turn all that noise into a clear, repeatable process? Well, that's exactly what we're going to do. Let's dive into a systematic way to prep for the trading day. So here's our game plan. First, we're going to talk about your biggest obstacle, and it might not be what you think. Then we'll build a flexible framework for your morning. After that, we get to the fun part, hunting for the right stocks. And finally, we'll run a quick quality check to make sure our plan is solid. Okay, before we even dream of looking at a chart or a scanner, we have to start right here. Because, the most important system you will ever manage isn't on your computer. It's the one between your ears. This really is the heart of it all. It's not about fighting some shadowy market maker or finding a secret algorithm. Nope. It's about mastering your own impulses, your own fear, your own biases. The moment you truly accept that, everything else just kind of starts to click into place. Now, this is a really interesting idea, the difference between confidence and conviction. See, confidence is purely emotional. It's you hoping, praying that this one trade is going to be a winner. And what happens when it's not? That confidence shatters. But conviction? That's totally different. It's logical. It's the deep belief that if you just follow your rules and execute your system, you'll come out ahead over time, no matter what happens on any single trade. And that's exactly why we're building a system in the first place. It's to take our emotional, gut feeling, in the moment selves right out of the driver's seat. The system makes the calls. You just execute the plan. All right, so with our mindset in the right place, let's talk about the actual framework for our morning prep. And pay close attention to the wording here. We want a structure, not a rigid, brittle routine. There's a big difference. Think of yourself like a pro athlete. Seriously, you wouldn't roll up to the championship game tired, distracted, or just not mentally there, would you? Of course not. It's the same thing here. If the person running the trading system isn't at their best, the system itself is pretty much doomed from the start. So, why structure over routine? Well, because life happens, right? The kids are running late for school, your internet decides to take a vacation, there's a surprise traffic jam. A rigid routine completely falls apart under that kind of pressure, and that leads to stress and really bad decisions. A flexible structure, though, that's a repeatable process you can adapt. It's built to bend, not break. And you know what the best part is? A good structure is super efficient. You do not need to be glued to your screen for hours before the market opens. With a focused process, you can be totally prepared with a full watch list built in just 15 to 30 minutes. That's it. Okay, let's get our hands dirty. This is the most practical part of our prep, finding the actual stocks we're going to keep an eye on. This is where we turn all that theory into a concrete, actionable list. As a day trader, your biggest enemy is time. You need stocks that are moving right now. And what makes a stock move? Volatility. And volatility is just a fancy word for a whole lot of people buying and selling. Our job isn't to guess what the news will be. It's to find where the party is already happening. So how do we find that party?
We use a super simple but really powerful scanner with just two rules. First, we want pre-market volume of over 250,000 shares. That tells us there's already a ton of interest before the opening bell. Second, a price somewhere between 20 and $400. This helps us dodge the crazy, unpredictable behavior of penny stocks, but also keeps us away from super high-priced stocks that just eat up too much capital.
And here's what that looks like in the real world. See how simple that is? Just two little filters. The goal here isn't some crazy 20-point complex scanner. It's just an effective filter that cuts right through all the market noise and shows you exactly where the action is.
And the result of this simple scan is actually pretty amazing. It takes thousands upon thousands of stocks and just boils them down to a nice, manageable list of maybe 5 to 20 names. This is what saves you from analysis paralysis. You can't possibly trade everything, so you just focus on what's hot, right here, right now.
All right, we have our list, but we're not quite done yet. It's time for the final step. We need to quickly check these stocks to make sure they're actually high quality, and then create a prioritized game plan for the open.
Think of this as a quick mental checklist you run through. First, is the volume coming from lots of different traders, or is it just one giant untradeable block order? Next, is the spread tight? In other words, is the gap between the buy and sell price small, so you're not losing money the second you get in? Third, does the chart look clean and orderly, or is it choppy and all over the place? And finally, does the order book show real participation, or is it thin and empty? If a stock fails any of these quick checks, boom, it's off the list.
Okay, so in those last few minutes before the open, you use a tool like this to get a feel for the market's bias. Now, the goal here isn't to analyze every single number you see. Not at all. It's to make one quick judgment. Does this stock look like it's setting up to go up or go down right at the open? This final check helps you rank your list, putting the stocks with the cleanest setup right at the very top. So let's just put a bow on this whole thing. Here is your 4-step pre-market system. Step 1, prepare yourself. You're the system controlling the system, remember? Step 2, run that simple volume and price scan. Step 3, do the 4-point quality check on what comes up. And step 4, in those final minutes, rank your refined list based on what the market is telling you. That's it. A focused, repeatable process you can use every single day.
And that brings us full circle, right back to where we started. You see, having a system, that's one thing. But having the discipline, the conviction, and the mental grit to actually follow that system, trade after trade, day after day, well, that's the real game. So the final question isn't about the market at all. It's about you. Are you prepared to execute?
So, what if I told you the secret to consistent trading profits isn't buried in some Wall Street textbook, but you can actually find it at a poker table? Today, we're going to break down a system that treats trading risk not like some guessing game, but like a calculated science, and it's borrowed directly from the world of professional gambling.
Now that's a pretty bold statement, right? The author of our source material here, Thor Young, he doesn't shy away from it at all. He basically argues that, yeah, traders are gamblers, but he says that's not a bad thing as long as you're a professional gambler.
And that's really the million-dollar question, isn't it? It's not about luck, and it's definitely not about being right on every single trade. The thing that separates the people who win consistently from those who just blow up their accounts is having a system.
Okay, let's start with the mindset, because it's absolutely key. A professional poker player, they don't walk into a game expecting to win every single hand. They know they're going to lose plenty. Their whole goal is to just have a statistical edge that makes sure they come out ahead over the long haul. And for traders, your system, that's your edge.
This right here is the core difference. It really boils down to this. Amateurs are running on hope. They hope a losing trade will turn around. They hope for that one big win. Professionals, though, they rely on a repeatable mathematical process. They actually plan to lose, but they plan their losses so that their wins more than cover them.
So how do you even build a process like that? Well, it all starts with one simple but incredibly powerful concept. It's designed to take emotion out of the equation and make your risk predictable every single time. It's called RR.
R is just your risk defined as a fixed dollar amount. So let's say your R is $100. That is the absolute maximum you will lose on any single trade. Period. It doesn't matter if you're trading Apple or some tiny biotech stock. Your risk is always 1R, or in this case, $100.
This makes risk a simple, controllable number in every single trade you take. And this chart, this is where the power of R just becomes so obvious. Just focus on the row for a 3-to-1 risk-to-reward ratio. All that means is for every $100 you risk, you're aiming to make 300. And as you can see, with that ratio, you only need to win about 30% of your trades just to break even. If you can win just 4 out of 10 trades, you're solidly profitable. This is the math that proves you don't need to be right all the time to make money.
Okay, so we've got our risk totally defined. Now let's talk about the other side of that coin, taking profits. How do we lock in those wins in a systematic way?
There are really 2 main ways to think about it. A scalp is the simplest. You get in, you hit your profit target, and you get out all at once. Done. Scaling out is a bit different. You get in once, but then you sell your position in pieces at different pre-planned profit targets. This is great because it lets you lock in some gains while still leaving a piece of your trade on the table to catch a potentially bigger move. And you can see it right here. On the left, that scalp trade is super clean and simple. 1 entry, 1 stop, and 1 all-out exit. But look over on the right, the scale-out trade has multiple profit targets. This lets the trader cash in parts of their position as the trade moves in their favor.
All right, now that we have the system, we need to talk about the one thing that can destroy it all. There is one mistake, one cardinal sin of risk management. That is the #1 reason most traders fail.
You know, the source material is incredibly clear about this. This isn't just another mistake on a long list. This is the account killer. It's that desperate move that just completely destroys the mathematical foundation we just built. It's called averaging down. This is when a trade goes against you, and instead of cutting your planned loss, you buy more. And why would you do that? Because the pain of admitting you're wrong feels worse in that moment than the risk of losing more money. You're adding more risk to a trade that is already proving you wrong. It's the ultimate emotional decision, and it is a one-way ticket to blowing up your account. Let's really break this down. On the left, you've got the trader who's bag holding a losing position. Their risk has just ballooned and they need a massive move just to get back to even. But look at the trader on the right. They took that small planned 1-hour loss, got out, and then got back in at a much better price. They managed their risk, and weirdly enough, they ended up with the trade that has more profit potential. And this is the key takeaway. A small planned loss is not a failure. It is a strategic advantage. So this brings us to the final and honestly, the most difficult part of the whole system. The math is simple, the rules are clear, but there is one variable that can throw the entire thing into complete chaos.
Think about it. When you're trading on a simulator with no real money on the line, the equation is pure. Your system, A plus B, consistently gives you a predictable result, C. The machine just works perfectly because there's no emotion involved to break it.
But the moment real money is on the line, that equation changes. A new, completely unpredictable variable gets introduced, I. And I stands for you, your fear, your greed, your hope. All these emotions don't just add to the equation, they multiply, and they corrupt the entire system.
And this is the ultimate takeaway, really. The professional risk management system itself, it isn't complicated. It's just simple math and unwavering discipline. The system isn't the hard part. The real question is whether you can control that I variable, your own emotions, and execute the plan flawlessly. The system works. The challenge is, can you?
When you're trading in the markets, what's the single biggest threat to your success? Well, I'm going to bet the answer isn't what you think. So let's dive in. So we're digging into some insights from a trader named Thor Young, and he makes a really powerful claim right out of the gate. It's not about finding some perfect magical system. Nope. The most important, and let's be honest, the most unpredictable part of any strategy is the person, the human being actually clicking the buttons.
And that, right there, leads us to a pretty uncomfortable question, doesn't it? We spend all this time analyzing charts, news, algorithms, but what if the biggest variable, the one that really decides whether you win or lose, is looking right back at you in the mirror?
So to really get a handle on this, we've got to accept a tough truth. We are the key variable. It's not the market conditions, it's not the system's win rate. It's our ability, or inability, to execute that system when the pressure is on.
Look, the market is easier to get into than ever before, right? Millions of new people are jumping in. But here's the kicker. The stats haven't really changed. Most will not succeed. And the common reason isn't some faulty strategy. It's a breakdown in the trader's own head when real money is on the line.
Okay, so what does this psychological breakdown actually look like? Well, it often kicks off with something that feels amazing, but is actually super dangerous. I'm talking about the confidence trap. Think about it like this. Trading on a simulator, it's like playing one of those NASCAR racing games at an arcade. With zero risk, you feel like a total pro, right? But trading with your own money? Man, that's like stepping onto the actual racetrack at Daytona. The pressure is insane, the consequences are very real, and it demands a completely different level of skill.
And that feeling, that arcade simulator confidence, it actually has a name, the Dunning-Kruger effect. That easy confidence puts you right at the very top of what this graph calls the peak of Mount Stupid. A tiny bit of knowledge makes you feel like you're invincible.
For new traders, this curve is an almost perfect description of the journey. You get a few lucky wins and it feels so easy, that's you on top of Mount Stupid. Then, bam, the first real painful losses hit and you just plummet into the valley of despair, questioning everything. Only by pushing through that can you start the slow, humble climb up the slope of enlightenment toward actual competence.
All right, so how on earth do you survive that valley and start climbing out? The answer is, well, it's probably the opposite of what you'd expect. You have to totally change your relationship with losing.
Here is the absolute key. You have to remove yourself, your emotions, your ego, your fear, your greed from the equation. Think about it. If you're the one messing up the data, how will you ever know if your system actually works in the first place?
Your one and only goal should be to collect what Young calls pure data. This is the only way you can truly know if a strategy is any good. Did you follow your rules to the letter? Did you take that loss exactly where you were supposed to? If you didn't, the data you're looking at is corrupted by your own emotions, and honestly, it's worthless.
This requires a complete shift in your mindset. You have to stop seeing a loss as some kind of personal failure. Start seeing it as just the cost of doing business, the price you pay to get that pure, clean data. It's just like the ante in a poker game. It's a necessary, calculated cost just to play the hand.
Okay, so that's the theory, the mindset. But how do you actually do it? Let's get practical and look at a simple tool you can use to grade your own performance. The process is super simple, and most importantly, it's objective. You just commit to executing a block of 25 trades, sticking to your rules with zero exceptions. Then, you grade yourself, you analyze what happened, you adjust, and you do the whole thing all over again. And here is the report card itself. Notice, this isn't about how much money you made or lost. It's all about your win ratio, assuming you followed your rules perfectly. An A means, okay, the system is working. A B is a yellow flag, a warning sign. And an F, less than 15 wins out of 25, that means something is seriously broken and it's time to hit the brakes and figure out why.
And part of this whole disciplined approach is just about basic survival. We use R to mean your risk unit. Let's say it's 1% of your account on any given trade. The hard and fast rule is you should never, ever lose more than 3 R in a single day. A hard stop like this prevents one disastrous day from wiping you out of the game for good.
Now, let's say you get that F grade. Your first instinct is probably going to be to blame the system, right? But it's so important to think about something called the halo effect. Is stress from your job or your family life bleeding over into your trading? Trying to be a peak performer in the market is nearly impossible if the rest of your life is in chaos. Sometimes you got to protect your capital from yourself. And this all brings us to the final and honestly maybe the most important piece of this whole puzzle, managing your expectations for the long haul.
Look, becoming a consistently profitable trader isn't something you do in a few months. This is a multi-year career path, just like becoming a doctor or an engineer. Year 1 is pretty much just about survival. Consistency, if you're lucky, comes in year 2. And that real deep market intuition, that takes years and years to build.
And let me be crystal clear about this, there are zero shortcuts. None. All the books and courses in the world are great, but they can't replace what the source calls saddle time. Those thousands of hours spent in the live market, executing trades, collecting data, and learning the hard way.
And you know what? You can't do this in a vacuum. The pressure is just too intense. Having a supportive environment, a family that's on board, managing your outside stress, realistic expectations, that's not just a nice to have, it's an absolute requirement if you want to survive in this field long term.
Which leaves us with one last big idea to chew on. We all get into this game to try and master the market, right? To figure out its patterns and movements. But what if? What if the whole thing is actually a test of something much deeper? What if, before you can ever hope to conquer the market, the real battle is to first conquer yourself?